Hello, everyone, and welcome to the sixth in a seven-part series by SCORE Fairfield County and our co-sponsor, Fairfield County Community Foundation. If you missed a prior webinar in this series, you can view the recording on Fairfield County SCORE's YouTube channel at any time. I'm Bill Presley, the webinar coordinator and a business mentor here at SCORE Fairfield County, and I'll be your host. For those of you familiar with our webinars, there's an important distinction with this series. We will have a mentor reach out to you and after today, and we're hoping that you will work with your mentor to develop a plan to help you grow. Whether you are an existing business or looking to possibly launch a business in the future, you will benefit from a review session with a SCORE mentor. Next Wednesday, June 23rd, will be the last live webinar in this series. If you missed any of the webinars, you will be able to catch up by viewing them on our on-demand YouTube video channel, which will be available within a day or two after the original presentation date. Today's webinar is titled Financing Your Small Business in 2021, presented by Patrick Lorent. More on Patrick in just a minute. First, some brief information about SCORE. SCORE has about 300 chapters throughout the U.S. and over 11,000 volunteers. We are part of the SBA. SCORE Fairfield County has about 130 volunteers with a wide range of industry, process, and subject matter expertise. We offer three primary value-added services to small business owners: free one-on-one counseling, face-to-face, telephone, email, or video, which can be accessed via the Request Mentor link on our website or via the link on the screen. Note, we're currently not doing face-to-face mentoring until further notice. Also, we offer educational workshops and webinars. We do over 150 of those a year. Extensive resources are available on our website, including a network of subject matter experts at your disposal. SCORE puts on many webinars each month. Look for future events on our webinar calendar at fairfieldcounty.score.org. Some useful information about today's event. If you have a question, please use the Q&A window at any time during the presentation. It's located in the lower part of your screen. Our webinar will end at 1 o'clock to respect your time. The session is being recorded, and the link to the recording will be available at fairfieldcounty.score.org within the next couple of days. Now our speaker. Patrick Lorent has over 30 years of experience in the commercial lending industry. He is a vice president and manager of People's United Bank Government Lending Department. He volunteers at the Liberation Programs, Inc. and at the Connecticut Minority Supplier Development Council. Patrick is a graduate of Morehouse College and the University of Connecticut. Welcome, Patrick, and it's all yours.
Thank you, Bill. I appreciate it. Thanks for the kind invitation. We certainly appreciate it. So today we're going to discuss how to prepare yourself to meet a banker and what information you'll need to present to a banker, understanding your credit, understanding how banks interpret financials when they look at your application for credit, and some sources, various sources that are available to you to apply for a commercial loan. So you can go to the next slide. Right. So the first topic, what do you need to apply for a loan? The couple of next slides will tell you, but we'll talk about that in detail. Next slide. So traditionally, there's five tenets that a bank will look at when they are considering your loan, and their character, capacity, capital, condition, collateral. And so just to talk a little bit about each one. So, character is pretty straightforward. We look at, your experience, your wherewithal, and what you bring to the table to try to, to run the either new business or existing business. Capacity is really your ability to pay back. And you could almost call that credit as well, where we're assessing your credit and your ability to pay back. Capital is, really it's going to be your equity that you bring into the deal. Typically, banks are looking, it could be anywhere between 10% and it could be as much as 50%, depending on the type of transaction. And, whether it's a startup or an existing business or, some of the risk that are in the transaction. You can go to the next slide. The other two are condition, and condition is a very important one, especially in these days. Obviously, last year, if you were a restaurant or a daycare or, maybe a doctor's office, you were severely impacted by the conditions. We all were. But on the other hand, if you are a delivery business or, you develop online portals or, you were in the business of, personal protection equipment, maybe you did very well. So conditions are very important depending on the type of business you are. Collateral is, a bank is going to look at what's the secondary source of repayment. And that's going to come in the way of, taking a position on your business assets, or it might be even your personal assets. And I'll talk about that later. Next slide. So, how to prepare. The first thing is really to understand your business, and be prepared to explain exactly what you do. And, I have a little link, and I will share in the SCORE can share this presentation, but it's a 30-second elevator speech. Understand that really well. Your first impression is your very, very more important impression, right? You can't make a second impression. The key parts are, having a concise description of your business and understanding your business cycle, understanding your competition and being able to explain that, how you fit in there. Explaining projections. If you're starting a new line of business or you're starting a business period, understanding your projections are very important because, a bank is going to look at that. That will be the key part in terms of, trying to qualify you for the loan that you're looking for. Management, of course, no business runs itself, it's the management. So, being able to explain your experience and the wherewithal that you bring. Succession plan is an important piece because, what's your way out? Is it, your training second tier management? Your plan is to sell within 5 to 10 years, or are you building something that the next generation is going to take over? And so being able to have a succession plan is important. Next slide. So now that you're ready to apply, these are the things that you typically will need to have ready to apply for a loan. The first 4 things are probably, almost all businesses are going to need to do. The loan application, your tax returns, business and personal, and depending on the type of business or the type of loan that you're going to apply for, you may have to provide a schedule of your accounts receivables and payables. If you're a new business, right, a business plan, if you're buying a property, a lease, a purchase agreement, if you're buying a business, and you'll need a copy of the returns of the business that you're buying, because that's going to be really the historical source of where, the company performed. If it's a franchise, of course, a copy of the franchise agreement. So depending on the type of loan that you are, you may need a combination of this information. But this is the typical information that a bank will ask for. Next slide. So, as I talk credit, obviously the bank is going to look at, your personal credit history and how you have handled your credit. And that is probably, especially if you're a startup, that's the basis of where, that character comes in, where, how have you handled your credit in the past, is a prediction of how you're going to handle your credit in the future. So personal credit, next slide, we'll talk about that a little bit. Understanding your credit score. And as you can see, utilization and your payment history is the two largest components of how your personal credit score is determined. So I always recommend that prior to you going to a bank or, a financier or any type of finance company, you pull your credit report. And I provided the 3 credit agencies and their contacts, and there's a hot link to their websites on this presentation. So each person is able to annually ask the credit agencies to give you a copy of your credit report. So I would recommend that you pull that report and be prepared to answer any questions that a bank may have. So you could see the utilization rates, 30%. I mean, that's the best. If you can keep your credit debt, or your debt below that, you're revolving. So that's like lines of credits, credit cards. It might be second home mortgage or home equity. If you can keep your balance between below 30%, that would garner you the best credit score. And of course, missed payments are missed payments. So, and understanding that, no one's perfect. So there may be missed payments, but being able to explain that is key. Why did it happen? How did you resolve it? Next slide. So, what types of loans are best for you, depending on what you're looking for. Next slide. So they're long-term and short-term. So is your need to finance, short-term assets like receivables, inventory, accounts payable? And that would come in the way of a line of credit. So, understanding your credit cycle. For instance, you purchase goods, you make goods, you bill people, and you get paid. That's your credit cycle, typically, right? So you may need a line of credit to purchase goods, right? You borrow, and then once you get paid back, then you pay back the line of credit. And that's our short-term, under 12 months. Long-term needs are, if you're buying a building, equipment, doing leasehold improvements, or you have a long-term growth plan, those are a term loan where you'd be paying it back anywhere between 5 and 10 years. So understanding your credit need and being able to explain it is very important. Next slide. So how does a bank interpret your application? So I put together a little example here. And so I'm not going to read this all the way through here, but the most important piece here is that if you look on where I highlighted the red and the green, you have a manufacturer that has direct and indirect experience. There are 2 partners. One has the day-to-day relationship, and the other really does the financing. Their terms, 45% or 45%, one of their customers makes up 45% of their sales. That's an important piece in this example. And so currently they have $560,000 in debt, some term debt, some line. They're looking for another $200,000, an increase of $150,000 in an equipment line, and then another $50,000 in working capital. Next page, please. Next slide. So here's their financials. And so I just really want you to today get an understanding of how banks look at this. It's not the point is not for you to understand, credit analysis here. But the important piece is, they're looking for a line of credit, an increase in a line of credit, and they're looking for additional term debt. And the question is, what do they have to offer as collateral for that loan? And so if you look on their balance sheet here, you'll see that they have receivables and inventory of combined of $326,000. But as you saw, they had $560,000 in debt, and they're looking for another $200,000. So clearly, they don't have the supporting assets to support the increase, or even the existing for that matter. But on the other hand, if you look at their income, they are very profitable. They had net profit of $111,000. Okay, and they had some non-cash expenses, depreciation and amortization of 27, and they had interest income or interest expense of 25. And those are the things that the bank will add back to determine the amount of cash that they have available to support the debt that they're looking for. So if you add those numbers up, they have $163,000 to support debt. Okay, and that came in the way of depreciation. You add back the interest and their net income. Their existing annual debt right now is $79,000. The proposed debt that they're looking for, another $200,000, right, is $27,000. A total of $106,000 in annualized debt that they would have to pay, right? That they would have to pay back annually. But they had $163,000 available, $57,000 surplus. So their ability to pay it back is very good. But the weakness is that they don't have the supporting assets to support the debt that they're looking for. Okay, so next slide. So when we're thinking about this, right, they had, $79,000, right, that they had to pay, and they're looking or existing, and then they had $27,000 in new debt, right? So for every dollar that they're spending, right, they had $1.50 coverage, right? Most banks are looking for you to have at minimum a 1.2 coverage. That gives you a little cushion. So if something happens, right, it's not 1-to-1, right? It's at least 1.2. That's what most banks look for. This company had 1.5% coverage. Next slide. The collateral was the issue, right? If there's, every bank is going to look at your balance sheet and look at what are the assets that are available to support the debt that you're asking for. And in this scenario, right, they had receivables, inventory, and they had net fixed assets, right? Those are the assets. If you remember from the example, this was a business that was around since like 1964. So the vast majority of their assets were fully depreciated. So their net fixed assets was only $14,000. That they were almost fully depreciated. A bank is not going to lend you dollar for dollar on your assets. They're going to look at an advance rate for each type of assets. So you had receivables, inventory, fixed assets, and you could see it's 80% and 50% on the other in inventory and net fixed assets. So they only had available collateral of 231 versus 560 existing and 200 new. So they had obviously a pretty severe shortfall. So how do you address that? Next slide. So one, right? They had two individuals that were in their mid to late 50s. So you'd want to see a succession plan. Two, the issue was collateral, and three, if you remember, one of their customers made up 45% of their sales. So these are the types of things that a bank will look at in terms of concerns of maybe, there'll be issues in this credit request. So what are the mitigants here? How can you mitigate those risks? Primary one, which I'll talk about more in depth in the next couple of slides, is an SBA guarantee. And an SBA, at the moment, like this year, they're providing a 90% guarantee on SBA loans, on loans. And so, somebody give me a little note there, sorry. So, that would induce the bank, right, to say that, maybe we'll overlook the concentration in revenue and the collateral shortfall because we have a 90% guarantee. Additionally, if something happened to one of the individuals, right? One of the individuals was the person that had the day-to-day contact with the customers. If something happened to that person, right, where would the business be? And so the bank may ask you to have an assignment of key man life insurance. So term life. So maybe the bank would say, because, you don't have a succession plan in place, there's two individuals that are the primary people that run this business. And if something happened to one or the other, there would be a very severe disruption in business. So we would like you to get an assignment of key man life. And so those are the mitigants. Next slide. So, what are the best sources of capital? We would really talk about how to finance your business. I will tell you that most businesses finance it from personal resources. I'd like to tell you, that banks and do most of the finance, but that's not true. Most businesses, startups, are financed through personal resources, home equity, 401k, life insurance, the cash, if you have cash surrender value of life insurance, you borrow against that. Family and friends, vendors and customers, and there's some local sources that I'll talk about. And then the more in terms of the bank, in terms of startup, or, let's say if you want most banks will lend you, like if you're borrowing to buy a business, the maximum term that most banks will do without SBA support is 5 years. Now, maybe you can't pay back in 5 years. So that's why they would give you or request a guarantee on that loan so we can extend your repayment term up to 10 years. So there may be a leverage issue, right? There may be a concentration in receivables. There may be a credit issue. So there may be a debt service issue. And so those things are mitigated by the SBA guarantee. The more kind of, newer types of things are crowdfunding. And I put in a few of the different places, and you could go to their sites. I would encourage you to go look to them. They're a little more expensive than a traditional bank, right? But they are a really great source of financing. Lease financing, if you can negotiate something with your landlord, to do renovations or do an expansion program. I've seen that many times where you will finance yourself through a lease. Next slide. So sources of financing, I've been talking about the SBA, for quite a while here in terms of what, a bank will use. And this is the primary program that most banks use, for if they find some risk in the loan request. And at the moment, a bank can get anywhere between 75 to 90% guarantee. So it's a very good time, for lending for both the borrower and the bank, because it will really give you, there may be some severe risk in the transaction, but because we can get that guarantee, we may get to a comfort level of lending you the money. Most of the times you're going to have to put down a minimum at least 20%. I will tell you with an SBA guarantee, you could put down as less as 10% on the transaction. So the 7A program, you've got the Express program, and the same types of guarantees that are available. You've got another program called the Community Advantage, and then there's intermediary loan program or loan programs out there that I'll talk about in the next couple of slides. And they will typically do about up to 150, but their terms are probably much more relaxed than a traditional bank. Okay, next slide. Someone raised their hand. They want to ask a question. Do we want to pause or want to wait till the very end? Can you unmute those people, or do we just want to wait till the end?
Please continue. We'll answer questions at the end.
Okay, all right, sounds good. So some state government funding, there's the Express program. Again, that's an SBA program. And I'm sorry, I misspoke. The Connecticut the Connecticut Department of Economic and Community Development. These are some of the various programs that they have available. So, you could read this here, and like I say, I'll provide this presentation. I know I'm going a little quick here, but I'll provide this presentation to you to anyone that wants it, and you could look into these various programs that are available. Next slide. So again, on a federal side, excuse me, the 7A program, you could borrow up to $5 million, through that program with a 90% guarantee. The interest rate is the maximum interest rate that a bank can charge you is on the 7A program is prime, which is 3.25 plus 2.75. So the rates are fairly good, they're going to be secured, if with business and personal assets. And as I said, the personal guarantee, you're typically going to put in about 20% into the transaction. Micro loans, again, they're $50,000 and they're available to nonprofits as well. Okay, and the interest rates will vary anywhere between 8 to 13%. And you could see the various terms. They almost finance just about all business needs. But you can go to the next slide. Okay, there's some more, secondary resources. Again, the Connecticut Community Investment Corp, a good source of a place to go look to borrow. You can see some of the terms that they offer there. Very good, because typically they're looking at, startups and more riskier transactions. Micro loans up to $50,000. You could see some of the key terms that they offer, right? Interest rate of 8%, 2 to 5 year term. Some of the key features there, okay, that they provide training and counseling. So very good source of where to look for financing. Next slide. So, and then there's some other alternatives, merchant financing, and I would say middle path financing, where, I'll show you some of the places where, you could see that they're much more expensive, but they're much more relaxed in their terms. And you can go to their sites and look to see what their terms and conditions are. But I thought I'd just put that in there because there are, various sources of types of financing. Next slide. The CEDF provides financing, and then, I named all the various terms that they provide. And at the end, I'll give you what their site and their contact is. Next slide. You can go. Okay. So additional sources. And so these are some of the sites that I just went through, right? Some of the secondary sources of financing, okay? And, the first 4 or 5 there, right, are some of the ones that I just reviewed. But you could also go to your towns, your local towns, like the Headco and in Bridgeport, in Stanford Purchasing Department, the revolving loan funds from the various cities. Usually the larger cities have these revolving loan funds, okay? You can go to the UI. They have a program where they will finance you. And if let's say if you're a retailer and your lights are on all day long, they will upgrade your lighting for you so that, it reduces your cost. You can go to places like the Greater New England Minority Supplier Development Council, an excellent source. They also have a financing source as well. I would encourage you to register at the federal and town level to the local, the various departments of the purchasing departments. And so I provided a few of the various, websites where you can go to look into these sources of financing. Next slide, excuse me. So with that, that's, I'd like to open it up and have a dialogue. If we can, open it up, I know a few people had raised their hands during the presentation. Bill or Bud, if you want to open it up.
Okay, Patrick, there's one question, and it says, is the Connecticut Community Investment Financing option best for startups seeking less than $50,000?
I would say yes. They will have much more relaxed terms than a traditional bank will have. And they have counselors that can help you through the loan process. I'm fairly sure in this presentation, I provided their website. I would go directly to their website and look at their, where to contact them and see where, if you can, set up an appointment with them and talk to them about your financing needs.
Also, Patrick, could you spend a little time talking about what things are available for women and minorities, as far as any programs that try to help them beyond just the standard programs?
Mm-hmm. A lot of these, SBA programs, they'll say that, they're geared towards women and minority businesses. But frankly, from what I've seen, I don't see the terms much different than what they offer everybody else. There are, this year, they are not charging any fees, okay? So it's a really good opportunity, if you need it, right? If there are some weaknesses in your credit. For instance, if it is a startup and a bank has to rely on projections versus historical information, they may require an SBA guarantee, but there's no fee for it. So there's no risk or there's no cost to you. Traditionally it would cost you, anywhere between 2 to 3.5% of the loan as a guarantee fee. This year it's been waived until the end of the SBA's fiscal year, which is in September, the end of September. So yeah, in terms of women, minority-owned businesses, are there programs out there? I did see there recently, and I could share it with you guys at the I could provide it and the folks at SCORE can provide it to all the participants. I did see a source where it named all the different sources of financing for women in minority-owned businesses. It was really a good listing of different options. I can't tell you I know all of them, but I will provide you that link. And what I would encourage, go take a look at it. And I am certainly available. If anyone has questions at the end of the program or afterwards that you think about it, I'll provide my contact, and you could certainly call me directly, and I could try to help where I can.
If you got a question, please enter it either via the chat or the Q&A window for Patrick.
Questions?
Okay. So Patrick, right now we don't have any new questions. Any closing comments as far as what you would like people to remember as far as pursuing sources of capital or financing?
Well, yes. I mean, what I would say is that, the SBA.gov is a great source to go to. I would recommend that you go there. There's a number of links that I provided in this presentation, but I would start off at SBA.gov, and it is a very good source of whether you're a startup or an existing business, and whether you're looking for short-term or long-term debt. I mean, I talked about the 7(a) program. If you're looking to buy real estate, there in the SBA, there's a program called the 504 program, which you could put down as low as 10%, and it's fixed financing for up to 25 years. Rates are very good right now, and as I said, there's no fee in terms of the SBA. There's no guarantee fee. You'll have to pay, the traditional, someone to close the loan, your attorney, the attorneys that close the loan, and the documentation. But the substantial piece here is that there's no guarantee fee through the SBA this year. So it's an excellent time to look to finance. So, again, I think if you can go to the next slide, my contact information is there.
Okay, we got one new question that came in also.
Okay. Yeah.
Okay.
Sure.
Okay. The new question is: are there lenders or resources who are more suited for debt consolidation, paying off startup loans that have high rates?
What I would say is, I would start off with the bank that you bank with. I would hope you have a relationship with that bank. If not, some of the credit unions are a good source. They're going to be able to give you the attention that some of the larger banks cannot. Because what I'll tell you is that a phenomenon in the industry is that a lot of these regional to national banks are really just doing credit scoring, up to 250,000 or so. You go into the branch, you fill out your application, and the decision is solely based on your business and personal credit score. So if you're looking for more of a traditional lender where you're going to submit, and in those cases, you don't submit any financials. They give you a decision very quickly, all right? Typically, your rate is probably going to be a little bit more, right? But the decision is very quick, and you get your money very quickly. But if you want more of a traditional based decision, I would go to some of the smaller banks and look, to meet someone, sit down and speak to someone, explain your situation, and look to get financing either through a credit union or some of the smaller banks. There's really, I can't tell you that, one bank is better than the other, in terms of, trying to consolidate debt. I would go to a few banks and see what they can offer, and you'll, like I said, you'll probably have, more success in some of the local and even regional banks than you will have in a national banks, because a lot of the national banks today, like I say, are, and it might be a good source for some people that you go and, within days you get financing, but for some people that may not work. And so you'd want to go to more of a local or even some of the regional banks that will do, will actually look at your financials and review them and sit down and talk to you about it and understand, what the circumstances are.
Okay, Patrick,
All right.
a few other questions came in while you were talking. First of all, the question is, you made a real estate reference earlier, and they wanted to know whether or not that was referring to residential or commercial real estate.
So, yeah, I'm talking all commercial today. It's commercial financing for, a small business.
Okay.
So, I was talking all in terms of commercial lending.
Okay. The next one is, does the SBA have a list of smaller banks that can be approached?
Yes. Matter of fact, what you can do when you go onto the SBA site, they have a I can't think of what they call it now, but when you go onto the site, what you do is you put in your information, and they will send your request to all the banks. And so if any bank is interested in your loan request, they will follow up with you. And so, it's kind of a, I would go, and they have a listing of all the banks that participate in their programs. So you can go onto their site and just say, look up the banks that are in my area, and they'll list them all. So yes, the answer is yes.
Okay. The other question is, would you recommend that a startup attempt to start and build a business credit score before seeking financing?
I would say yes. I mean, depending on what your credit is, I will tell you, like on the personal side, if your score is below 680, it's going to be difficult for you to get a commercial loan. Okay. So if your score is above 680, then I would say you have a fair chance of getting a commercial loan. And it obviously depends on your circumstances, how much you're looking for, how much debt relative to, your income, the collateral that you're offering, and all those, 5, 6 C's that I talked about at the beginning, But yes, what I would do is, I provided in this presentation the credit bureau agencies. Look to call them, get a copy of your credit report, and work from there. There might be, issues that are wrong, and you can improve your credit score. You may be able to, if you could pay down some of your credit card debt, that will improve your credit score. And it doesn't have to be at 30%. I mean, every amount that you pay down, it's going to improve your credit score. If you pay it down by 10, 20%, it's going to improve your score by, depending on your circumstances, it could, improve your score by 30, 40 points. So, but yes, I would definitely encourage you to understand your credit, your business and personal credit before you go to a bank or any financing source.
Okay. The next question is, what's the best source for nonprofit funding?
Well, you can go directly to the bank, okay, and some of those micro lenders do finance nonprofits, and I forget which page it was in the presentation, but there are some of the micro lenders do have lending programs for nonprofits, and so you can go directly to them. For instance, Community Investment Corporation, or what was the other one? I name, or I would start with Community Economic Development Corporation, or you can go to Community Investment Corporation. They all sound kind of the same, but they do provide financing to nonprofits.
Okay. The next question is, in terms of collateral, my understanding is that the SBA requires one. I don't have a house, so what other collateral can I offer?
Well, I mean, when the bank looks at your loan request, and if you don't have a house available, I mean, the good thing this year, as I said, and it depends on the dollar amount. I mean, if you're looking for hundreds of thousands of dollars, then that's a bigger issue. But if you're looking for 50, 100, $50 to $150,000, and a bank can get a 90% guarantee, and like in the example I showed, they had the ability to pay back, they just didn't have the collateral available, then you don't necessarily have to secure your guarantee with a mortgage on a home. The bank may be satisfied, but if you have a combination of issues, then it's a little bit more difficult for the bank to do. So you don't necessarily have to offer a mortgage, on a home if you don't have a home, but it really depends on your circumstances and the individual's bank's appetite to, what part of the loan that they, want unsecured. And like I say, this year, because of the 90%, because typically banks, the SBA was only offering anywhere between 50 and 75% guarantee. This year, because of COVID, they're trying to encourage banks to do more lending. They're offering a 90% guarantee. So, you don't necessarily have to have a home to secure your personal guarantee to get a loan. But again, it really depends on your circumstances.
Okay. And so the next one is a multi-part one, but I'm going to try and combine it together. She has $5,000 in cash and a 750 credit score, but no other collateral. And so she wants to know her options from the SBA or community financing if she's looking for about $20,000 to $30,000.
So if you remember all the different parts that I named, right? Experience, your ability to, it's not just the collateral or your credit score, but it's also your ability to pay back. So remember I talked about the 1.2 coverage, right? And went through the example, So do you have the ability to pay back? Maybe, if you have the down payment, you have a good credit score, but maybe a bank could mitigate if you don't have collateral, but you also have to have the ability to pay back. And has the business, performed, or has it, had losses in the last couple of years? All those things will come into play in making the credit decision. So, there's no one answer, credit analysis is not a perfect science. It really depends on each individual's circumstances. And I will tell you, my contact is here. I would tell you, feel free to give me a call. I'd be happy to review your personal circumstances with you.
Okay. That's all the questions we have. And so we'll give people a few seconds to enter any last ones. Could you advance the slide, Bud? Okay. And so as a reminder, a recording of this webinar is available within a couple of days on the fairfieldcounty.score.org website. Also, please register for the remaining webinar in this series, which will be held on June 23rd, next Wednesday, or for any other webinars at our website, fairfieldcounty.score.org. Also, mentors will be reaching out to you about your businesses. Please share with them wherever you are in the process. SCORE can help you succeed. On behalf of SCORE, I'd like to thank you all for attending today's SCORE Live webinar. And in closing, I'd like to give a big thank you to Patrick Lorent.
Yeah, my pleasure.
Okay, thanks.
Okay. Have a good afternoon, everybody. Bye-bye.